Right now, everyone's talking about what Jerome Powell and the Federal Reserve just did on September 17th. A 25 basis point rate cut may sound like just numbers, but here's the truth. This decision could affect your job, your mortgage, your credit card bill, even the price you pay at the store. Why did the Fed cut rates when inflation is still too high? What risks are they seeing in the economy? And most importantly, what does this mean for your money, your business, and the markets in the months ahead? Stay with me, because in the next few minutes I'll break down not just the headlines, but the real story behind Powell's decision, and why this single move could shape the financial direction of 2025. Today, we gather at a critical juncture in U.S. monetary policy. On September 17th, Federal Reserve Chair Jerome Powell and his colleagues on the Federal Open Market Committee announced a rate cut of 25 basis points. While seemingly modest in numerical terms, this decision represents far more than an incremental adjustment. It is a signal of the Federal Reserve's assessment of the economy, its balancing of risks, and its commitment to sustaining growth without losing sight of its price stability mandate. In the next 12 minutes, I will provide an overview of the circumstances that led to this decision, explore the immediate and long-term implications for households, businesses, and global markets, and discuss the challenges the Fed faces as it charts its course forward. Context and background. To understand the rationale behind the September 17th rate cut, we must begin with the broader economic landscape. The U.S. economy, while resilient in many respects, has been showing signs of strain. The labor market, once the crown jewel of post-pandemic recovery, has started to soften. Job creation has slowed, unemployment claims have ticked higher, and many firms are scaling back on hiring. This shift is not yet a crisis, but it is a warning sign. The Federal Reserve, charged with maintaining maximum employment, cannot ignore these developments. At the same time, inflation remains uncomfortably above the Fed's long-term target of 2%. While headline inflation has eased from its peak, core inflation, which strips out volatile food and energy prices, remains sticky. Tariff-related cost pressures and lingering supply-side disruptions continue to feed into consumer prices. Thus, the Fed finds itself in a delicate position. Inflation is not fully subdued, yet growth momentum is faltering. To hold policy too tight risks deepening labor market weakness. To ease too aggressively risks rekindling inflationary pressures. The decision's September 17 rate cut against this backdrop. The Federal Reserve opted to reduce the federal funds rate by 25 basis points. Markets widely anticipated this move, and indeed futures pricing had already incorporated it. Still, confirmation matters. The Fed's statement highlighted a shifting balance of risks. The committee acknowledged softer labor conditions and global uncertainties while reiterating its vigilance on inflation. Powell emphasized that this is not the beginning of unchecked easing, but rather a recalibration aimed at preventing a sharper slowdown. This nuance is critical. The Fed wants to demonstrate responsiveness without undermining its credibility as an inflation fighter. By cutting modestly, Powell signals support for the economy while keeping options open for future adjustments. Implications for households and consumers. What does this mean for the everyday citizen? For borrowers, this rate cut translates into slightly lower interest costs on variable rate loans, credit cards, adjustable rate mortgages, and certain auto loans. The relief is not dramatic, but it is tangible. For households already stretched by higher living costs, even modest reductions in borrowing expenses can ease pressure. For prospective homebuyers, mortgage rates may edge down, though housing affordability challenges remain tied more to supply constraints than interest rates alone. Still, lower financing costs could nudge activity upward. On the other side, savers and retirees relying on interest-bearing accounts will see yields soften. This trade-off is inherent. Easing financial conditions supports borrowers, but reduces returns for savers. Implications for businesses and investors. For businesses, the cost of capital is the lifeblood of investment decisions. Lower policy rates reduce financing costs, potentially encouraging firms to expand operations, invest in equipment, or increase hiring. This effect, however, is not instantaneous. Many businesses remain cautious, waiting to see whether demand justifies expansion. Equity markets have already reacted positively as investors interpret the Fed's move as both supportive of growth and consistent with Powell's commitment to stability. Bond yields adjusted modestly downward, reflecting expectations of easier policy. Global investors, meanwhile, view the decision as part of a broader trend. Central banks worldwide are grappling with similar dilemmas, balancing inflation persistence with growth concerns. The Fed's leadership role ensures that its decisions ripple across currencies, capital flows, and emerging markets alike. The challenges ahead. While the September 17th cut provides immediate relief, significant challenges remain. First, inflation persistence. Core price pressures remain elevated, and the risk of re-acceleration is real. If tariffs continue to drive up input costs, or if wage growth remains firm, inflation could prove stubborn. A premature easing cycle might force the Fed to reverse course later, a scenario that would damage credibility. Second, the lag effect of monetary policy. Interest rate changes take months to fully impact economic activity. The benefits of today's cut will not be visible overnight. Policymakers must therefore rely on forecasts and incomplete data, increasing the risk of miscalculation. Third, global uncertainties. Trade tensions, geopolitical risks, and divergent central bank policies create volatility. The Fed does not operate in isolation. Its moves interact with exchange rates, capital flows, and financial stability abroad. Finally, communication. Powell must continue to convey the Fed's strategy clearly to avoid misinterpretation. Markets are highly sensitive to every word, and misplaced expectations can amplify volatility. Forward outlook. Looking forward, the key questions are: will the Fed cut further? And how will the economy respond? If labor market weakness intensifies and inflation eases sustainably toward target, additional cuts may follow later this year. Conversely, if inflation proves sticky or re-accelerates, the Fed may pause after this move. The committee has signaled a data-dependent approach, emphasizing flexibility. Investors should watch closely the upcoming employment reports, consumer price index releases, and surveys of business sentiment. Each data point will shape expectations for the Fed's next steps. For households and firms alike, the message is one of cautious adaptation. Borrowing conditions may improve, but uncertainty remains high. The prudent course is to plan with flexibility, manage risks, preserve liquidity, and avoid over-leveraging in an environment still subject to shocks. Conclusion. In conclusion, the Federal Reserve's September 17th rate cut is not merely a technical adjustment, it is a reflection of the complex trade-offs facing policymakers today. Powell and his colleagues are navigating between the Scylla of inflation persistence and the Charybdis of economic slowdown. Their decision underscores the Fed's dual mandate to foster maximum employment while safeguarding price stability. For citizens, this means some relief in borrowing costs, but continued vigilance on inflation. For businesses, an opportunity to invest with caution. For investors, a reminder that monetary policy remains both a support and a risk factor. Above all, the September 17th cut is a reminder that monetary policy is not omnipotent. Structural issues, labor participation, productivity, trade dynamics remain beyond the Fed's immediate control. Policymakers, businesses, and households alike must remain adaptable as conditions evolve. As we watch the months ahead unfold, let us remember that the Fed's actions are only one part of the larger economic story. The resilience of the American economy depends not only on policy rates, but also on innovation, discipline, and the confidence of its people. Thank you for watching. Subscribe for more detailed videos